Thank you, Aziz, for that kind introduction. And thank you, Dr. Hans and Aziz, for having me here and giving me the opportunity to share with this audience some terrific discussions over the last 1.5 days. So, I'll try and hopefully add some value through this discussion. We've covered a lot in the last 1.5 days about various vectors and points of risk when it comes to the mainstream financial sector. We've spoken about central banks, we've spoken about banks, and various risks at a systemic level. I will take a slight detour, and as Aziz said, we are going to look at the newer players, the non-traditional players in the market, whether they are fintechs or tech fins. And we'll look at what kind of opportunities and threats do they kind of bring on in this ecosystem. So hopefully you will get some perspective on emerging opportunities and how the world will look like in the next 5 to 10 years. So Aziz has been kind to introduce me. I won't spend much time on this slide, but just to share that because of my background of 18 or 20 years as a banker, and I have worked in different roles globally, and now as a mentor to several fintechs, I will hopefully give a very balanced perspective. I'm not one of those gung-ho cowboy types who believes that fintechs are here to kill the banks and change the world entirely. I am more of a person who believes in collaboration and partnerships, and that's been my approach with both banks and fintechs, as well as the regulators that I engage with. Okay, so I think we've heard this at quite a few conferences that the world of financial services is getting disrupted, and it's getting disrupted exponentially by both fintechs and tech fins. And I've shown you 2 examples here. The first is Venmo in the US, which is a peer-to-peer payment network. I'm sure some of you or many of you have children or family members studying in the US. And if you talk to them, Venmo has become a verb. You Venmo money to your friends, the millennial generation. So that's one example of how a company which didn't even exist a decade back has become so mainstream in the lives of our consumers. And the other is WeChat Pay from China. Now again, I was having a chat with Aziz yesterday, and it's remarkable to think that this didn't even exist a decade back. And till about 6 or 7 years back, this was essentially a messaging platform, right? We were using it to chat, and now it has become a platform through which you pretty much do most of your transactions if you are, in China, including ride-hailing or ordering your groceries, etc. And some of the statistics and numbers are absolutely mind-boggling. And I'm sure they've changed by the time I'm even, sharing it now. The payment transaction volumes of WeChat Pay or Alipay is more than 5x of the payment transaction volumes of debit and credit card transactions combined in the US with both Visa and MasterCard. That's the kind of exponential scale it's gone to. It's grown 50x in the last 5 years, the kind of numbers which almost seem surreal. And these are just 2 examples from 2 different markets. There are many others. So the fact is, when you hear people talking about the world of financial services changing exponentially, it's not just hyperbole, it's happening. So let's look at why. And of course, this is just one way of looking at the world, my way of looking at the world. There are many other ways to slice and dice it. But I call it the solo-mo effect. So basically, the mobile has been probably one of the biggest drivers of bringing about this change. And we saw both those examples of Venmo and WeChat Pay. Essentially driven to the smartphone, and that's why all of these are such recent phenomena in the last 10 years or less. Local, essentially we are seeing the explosion of QR codes in so many marketplaces, right? So as Aziz mentioned, I ran the payments business for Citi in multiple markets. And we used to be significantly constrained with coverage. So, while we were, we had budgets, and while we had ambitions to always be number 1 in every market, we were severely constrained by the economics. You could only sign up 10,000 or 20,000 merchants because putting those many terminals in so many merchants was not economically feasible to expand from 10,000 to 1 million. It just didn't make economic sense below a certain point. And here you are today with QR codes, it's nothing but a simple sticker, and the whole economics gets turned on its head. Suddenly, you can sign up 1 million merchants, and if you go to markets like Philippines with Gcash, etc., it's already happening, at a scale which even I would have not been able to imagine just about 3 years back. And the third is social. Again, we were chatting yesterday, and I don't think I need to really elaborate on it, but the millennial generation, or what we call as the digital native generation, has really, grown up in that ecosystem. For them, social and their network, and we heard a lot about, network connections earlier in the morning as well, but the network is how these guys engage with the world, learn about the world, think about purchases, even think about money. And Venmo, again, is a classic case of that. There was a study which said that more than, or almost 2/3 of the millennials make their purchase decisions now based on what their social networks tell them. So that is the kind of brave new world we are living in, and we are going to only go further and further in that direction as the millennials get into the mainstream. Now, this again is a buzzword that if you've ever worked in a bank or even with central banks, you'll keep hearing it all the time. Customer centricity, how to make your products and services more and more customer centric. It's driven by changing user behavior. We've heard a lot about emerging technologies like cloud, etc., and the fact that between cloud and shared marketplaces, you have solutions which are exponentially scalable and significantly lower cost than what it took to develop similar products and services in banks just about 7 or 8 years ago. And finally, because of this, we are having business models which are changing. We probably haven't covered that much in this forum, but at a lot of conferences that I go to, when we talk about digital finance, it's seen as a significant tool in financial inclusion, digital financial inclusion. And you can use these kinds of fintech models to either service existing customers better, deepen relationships with existing customers, or go after whole new segments of customers. Again, when I was in banking, it's not that we didn't want to go after these 2 billion customers. Nobody was stupid enough to lose big opportunities. It's just that the economics didn't hold. I mean, you couldn't go below a certain level in the pyramid. The bottom of the pyramid didn't make economic sense for a mainstream bank. And today, with players like Grab, etc., and with all of these newer business models, you can suddenly reach out to tens of, or probably even hundreds of millions of new customers in a very, very cost-efficient and cost-effective way. So we are seeing this happening as well. Plus, we are seeing something interesting happening, and this is only going to get accelerated from here on. If Web 1.0 was about ICT, as we used to call it, right? Internet and communications technology. 2.0 is going to be all about, or 3.0 is going to be all about IoT, the connected devices. And we heard about it in some of the other presentations that we are talking about 7 or 8 billion connected devices. And numbers are being thrown around. So, irrespective of the specifics, there are some schools of thought which say that we'll probably reach about 50 or 40 billion connected devices in the next 7 to 8 years. So that's roughly what, about 5 or 6 devices per human being in this world. And each extra level of connection, each extra connected device, has that extra layer of risk which it builds. And in fact, many of you here may have known or heard or read about the huge West Coast outage that happened last year. And it was probably the first time that such a large-scale DDoS attack happened because of connected devices. It was not through malicious code which came through computers, but it was through, I think, those handycams and things like that. It was to connected devices which were not properly certified from a market which did not take due precautions. So we are living in a world where suddenly all that we thought about internet and connected devices goes well beyond just our laptops and tablets and phones to many, many more smart devices. Plus, another interesting thing is happening, and I've given you 2 examples here. These are just representative examples. There are many more. We call it ambient computing, and you can call it, ubiquitous computing or invisible computing or whatever. There are many terms bandied about. But essentially, with a combination of machine learning, biometrics, and machine-to-machine transactions. So on the left-hand side, you see, one of the food chains. I think it was in China, where through a combination of facial recognition, machine learning, and of course your biometrics, they are not only able to identify you, recognize you, recommend the order that they think would be most relevant for you based not only on your ordering history, but also your mood scanning. And that's when they would recommend, whether you should go for a double cheeseburger or whatever. So we are living in that kind of a world. It may be pilots or experiments right now, but it's certainly going in that direction. And on the right-hand side, I've given you, or I've shown you one example, which again is at a pilot stage. It's still in the innovation lab, but it's going to go mainstream pretty soon. Where, imagine this scenario. Your vehicle can enter a gas station. The gas gets filled automatically, and then your vehicle does a machine-to-machine transaction or exchange of information between the kiosk and your automated vehicle. The transaction data is exchanged, the payment is made, and the vehicle goes out. And I keep chatting with my friends in banking about how things are changing, and they think at times I'm exaggerating. I said, visualize this scenario. I ran a payments business for so many years, which was all about terminals and people and relationships and merchants. Where do you see any of this in this scenario? And as I said, this may be at a pilot stage now, but this is where the world is headed. So in a world of machine-to-machine transactions, we need to really rethink the role of the security as well as the financial institution. So what is all this leading to? If we had to distill some of these trends that I have shared with you, and which are trends which are likely to get accentuated in the future, I call it the 3 I's. So transactions are becoming instant, they're becoming invisible, and they are becoming intuitive or intelligent. Instant, obviously, we look at the example of PayNow in Singapore or various national payment systems or Zelle as a pilot or a project in the US. Invisible, and I think at a lot of conferences we give this example of Grab. You just hail a car, you get in, you get out, and the payment just happens in the background. So what the earlier example that I told you about the gas station was probably an extreme version of that, but we are already living in a world where taking out our wallet or taking out our credit cards or even our phones for QR code to make payments is becoming redundant. It's happening in the background. You don't realize it. It's all there on the cloud, and you can probably check it later on when you reference to your app. So it's becoming invisible, and I want to show you something when I speak about 2 other very interesting examples, Amazon Go and Alibaba Ima. I'll show you a video right after this. And the third is intuitive and intelligent. I must tell you one more example here. So I was having a chat a while back with one of my friends and classmates who's the regional head for one of the largest payment companies in the world. He's running it. He's running their Asia office. And I was telling him, how come you guys, when I do transactions through your wallets, you guys don't do any kind of OTP or two-factor authentication? As a banker, I have seen all my life, we talk about risk mitigation, best practices, and we are doing so many other mechanisms of two-factor authentication. Either you send SMS codes, or you use the biometric of the phone in newer devices, or you allow it through the app itself. How come you guys don't do it, any of it? And he said, we have machine learning which scans the transaction at the back end, and it looks for aberrant patterns. And it's really a risk-reward trade-off. I think we heard it from some of the other presentations as well. For them, the number of transactions which may lead to frauds or losses in this case is lower than the opportunity cost and the customer experience that they really want to reach out with. So, oftentimes when we talk about security and controls at such forums, there really isn't a very simple answer, or there's no one size fits all. It really is about every organization willing I think we covered it in one of the earlier presentations, where R in the risk stands for relative appetite. What is your appetite for risk, and how far are you willing to go and trade off risk versus customer experience? No simple answers here, and no right or wrong answers here. Visible, we spoke about instant, and we keep talking about frictionless and seamless customer experience. Classic case, it incorporates all of that. And we'll only see more and more of this as we go along. But there's a trade-off, as I said. There's a flip side to seamlessness or frictionless customer experience, which is as transactions become real-time and instant, so do risks. As I said, real-time credits and settlements mean real-time frauds as well. You don't have time to respond. You can only do it post the transactions, or some sort of a post-mortem. You can't do the kind of checks that we used to do in a conventional banking ecosystem. And as I gave you the example, that's not an isolated example. More and more financial institutions are struggling to find the right balance between risk mitigation and customer experience. Is it two-factor authentication? Is it tokens? Is it using machine learning to determine patterns? Is it all of the above, some of the above? No simple answers in this emerging world. Similarly, we talk about more robust KYC and AML, and what kind of identity risk it provides. We've heard that consistently since the morning. More data points on the cloud means more possibilities of identity compromise. And Aziz alluded to it, but I want to take it one step further. We are not just talking about your Facebook data of your name and address, etc. A lot of this data now is biometric data. We are talking about extremely sensitive information. If data is the new oil, you are talking about true gold mine of oil sitting there. The more data you collect and the more single point of failures you have, the more risk there is. And let me give you an example. And in fact, BSP is one of the champions of this in the Philippines. A couple of other regulators are exploring it as well. There is a dire need for financial inclusion in this part of the world, right? Not just in this part of the world, but Africa and South America as well, but we'll stick to Southeast Asia. So the regulators obviously understand that KYC is a challenge because there is no national ID in most of these places. There are very few documents. So how do you use emerging technologies to allow for a more seamless KYC? So they said we can use selfie-based KYC. So why do we need to have face-to-face KYC and get people going to remote provinces when your phone, every phone has a camera now? You can just take a selfie, and through OCR and machine learning, we can determine whether it is a real person, whether your face matches with your ID or any other picture. And we can make that exception for you if you are driving financial inclusion. Extremely great initiative to drive financial inclusion. But the risk of that is now suddenly you are talking about not just documents or coded data. You are talking about biometric data. You are talking about facial recognition and all such stuff which is stored in the cloud. So every kind of frictionlessness that comes through the emerging ecosystem of financial services through fintechs and tech fins has a trade-off, which is increased potential risks. And I gave you this example, right? Easy login. If you want to do biometric-based login or selfie-based login, yes, the customer experience is more seamless and it can be omni-channel, but that's the risk it showcases. And it's interesting. I know throughout the day we heard a lot of speakers, and very, very rightly so, talk about humans and culture or conduct as the point of risk or the point of failure or the weakest link in the chain. I want to go a little aside from that and say that emerging technologies can actually potentially mitigate some of these while the human aspect is there. But think about a world where more transactions are becoming machine to machine. The human is getting out of the equation. That means technology will have to figure out ways to counterbalance some of these tech risks. And I have given some examples. We spoke about single point of failure when it comes to ID data. And blockchain or distributed ledger is a classic example of potentially mitigating it. If you eliminate a single point of failure, technically it's difficult to break into a whole chain. And I won't go into the technical details of how and why, but it's certainly a doable solution. Some entities are exploring it. Similarly, you can have biometric-based data on the blockchain. You can enable seamless or frictionless digital identity without making it vulnerable. Similarly, if you use sensor data along with blockchain, you can have more frictionless or seamless audits. And you can have machine learning for aberrant pattern recognition and also for potential credit risks. I don't want to go into too much detail because we don't have time, but I'll just give you a couple of examples so that you are able to really visualize these things. I spoke about how blockchain can help secure digital identity. It's not theoretical. It's already happening now. I think there are 21 companies listed here. There are many more, a couple that I'm personally working with and I'm mentoring and I'm on their advisory board, who are using distributed ledger technology for digital identity. Again, I spoke about Audit, classic example. Bank of China is using distributed ledger to really make the whole process flow much more seamless and cut down the transaction time from days to minutes or seconds, because the whole thing is there on the chain, and auditing becomes, or multi-party reconciliation becomes that much simpler and real time. Another use case or application pilot which was done recently between, I think this was the Commonwealth Bank of Australia. Yeah, correct, Commonwealth Bank. Using smart contracts plus sensor data to track shipment of products and therefore, for trade finance. And the whole thing was done so that there was no issue of reconciliation or frauds or handoffs in terms of bill of ladings, et cetera, et cetera. And again, I could go on and on. I could present at least 100 use cases here over the next 2 hours, but this is so that you get a flavor of how it is already happening and why there are some potential mitigants already in place. I think we briefly spoke about blockchain as a possible solution. These are just some use cases. There are many more ways in which it can be applied. So in conclusion, while emerging technologies themselves are the source of the challenges we've heard about since yesterday, some of them do present possible mitigants or solutions, and I'm sure we'll cover more of that in our discussion. I hope that was helpful. Thank you for your time and attention.
Thank you very much, Malik. And, as if I didn't have